So some people, they completely shut down. They just go into a box. Some
Yep.
people, they open up. So what was like that for you, Share with us and
Yeah. Yeah. I
give
mean, I
some
would say,
advice to the people
the,
who are
the biggest
listening.
thing is the self work on yourself, because you
Mhm.
got to be around. I don't care if you're around the right people, around people in general, listening to podcasts, dealing with self development, going to conferences that where you're around the right mindset of people. But that kept me in a positivity mind. Okay. Number one, because it's very easy to get in negative self talk, negative rut, negative
Exactly.
this, negative that. And so you got to move through that. There's ways you can do that. Tony Robbins is great at it, but there's ways you can do that. So that was number one. Number two was I watched what my dad went through and I understood why it happened. He was in the build and sell game. He was just very good at making a bunch of money, but he was also susceptible to losing a lot of money because of that, because he would mimic real estate cycles. And that's because he was in the build and sell game, not the build and hold game. And so I said, when I go do this, I'm going to do it based off of a buy and hold, right? I want cash flow and I want low leverage.
Welcome to the Wealth Vibe Show, where we explore how wealth is built, protected, and expanded, not just financially, but mentally and spiritually. Today's guest is the definition of resilience. Justin Brennan is a third generational multifamily investor who went from his family's $16 million bankruptcy to building a $185 million real estate portfolio across 5 states. He's the founder and CEO of Multifamily School and the Brennan Fall Capital Group, helping over 4,300 investors start or scale their portfolio with purpose and precision. He's also the author of Multifamily Playbook and a trusted mentor in the world of real estate wealth building. Justin, welcome to the Wealth Vibe Show.
What is up? Thank you for having me on. I mean, I love the name, by the way. I mean, the wealth vibe, because, I mean, listen, real estate's just one piece of the bigger picture of people's money at the end of the day. And most people, I'm sure you find out from a lot of your listeners and followers that, money's a tool and it gives them the chance to really spend time doing things they really love, which is family, travel. You're getting ready to go to Australia. I'm jealous, all that stuff.
Thank you for saying that. And I think I was thinking on the same lines too when I came up with this name because everything is a vibration in this life, right? And wealth or money, whatever you say, is also a vibration. So as long as we understand that, we're going to be in tune or aligned with that. So topic for today is from 60 million bankruptcy to $185 million empire. Kudos to you. So let's start with the first question. I think I'm going to start with the fall that redefined everything for you. So take us back to the beginning when your family lost 60 million in 2008, I think you said. And what was going through your mind and what did the moment teach you about wealth security or starting over again?
Yeah. So, it was really my dad that went through that bankruptcy, but obviously it was our family. So I got to watch the whole thing collapse. And if anybody was around and part of that financial crisis from 2008 to 2010, it was pretty violent. Um, I grew up in real estate a bit. I kind of came out of it. My grandmother was kind of the first person in our family that started
Mm-hmm.
in real estate, and God
Mm-hmm.
bless her soul, she was 91 years old, driving around in a little S10 Chevy truck, collecting rent from her tenants in San Diego. And she did it all kind of on her own with her own money and kind of grew that mini portfolio for herself. And then she passed that information on to my dad. And my dad was kind of that, Ed Milet would call it that transitional character in your family.
Uh-huh.
The person that goes from zero to hero
Uh-huh.
and, made things happen. I mean, didn't grow up in wealth. None of us did, but became a self-made multimillionaire,
Mm-hmm.
all through hustle. His dad died when he was 3. Had a stepdad that was not a good stepdad, kind of abusive, both physically and verbally.
I'm
He went
sorry.
off to Vietnam in the Army, became a door gunner. He was supposed to be the driver of the Jeeps for the admirals. And they said, no, you're going over here. And he ended up becoming a door gunner in the helicopters. And the average lifespan was 7 days.
Mm-hmm.
And they'd get shot up all the time. And so he got shot up many times. And he said, Justin, you were about a quarter of an inch from never being born, son.
Oh.
Both you and your brother and the whole family.
Mm-hmm.
But came home from Nam and got into real estate and had his real estate broker's license, started doing some sales, hated it, and said, I want to build. I don't want to sell. So he started building little homes. And then it scaled from there into like little subdivisions
Mm-hmm.
of homes, and then scaled from there into large apartment complexes and condo complexes and all these things that he would build.
Uh-huh.
But he was always in the build and sell game, where he
Uh-huh.
would build and sell, build and sell, build and sell, but never build and hold.
Mm-hmm.
And so that was great because he could make a lot of money and he was very good at making a lot of money. But then he was also very susceptible to the market cycles
Mm-hmm.
and over leveraging. And if you get caught, right, things can happen.
Mm-hmm.
He made it through 3 different cycles. And
Mm-hmm.
then the big one of the financial crisis of 2008-10
I've heard
came.
of. Mm-hmm.
He was highly over leveraged right in the heart of it, building a bunch of stuff. And so
Mm-hmm.
everything was great, except, when the values dropped 60%, and you got, $80 million in debt outstanding with $20 million in assets, well, you got a $60 million gap.
Mm-hmm.
And that's where the implosion happened. And I watched it all go down. And I'll never forget it. It was April 8th, 2008. I want to say it was around like 8:30 in the morning. And my
Mm-hmm.
dad walks into my office because I was working for him at that time, sits down, closed the door, and said, the bank's just called and they're shutting down all the construction loans because we were under construction of a lot of things. And I looked down and I said, well, they can't do that. Like, we have loan docs, we have loans. Like, you
Mm-hmm.
just do that. And he
Mm-hmm.
says, yeah, I told him that too.
Mm-hmm.
But they said, sue us. We're shutting everything down. Everybody was going under, right? It's like everybody get in your corner and lawyer
Yeah.
up and get your boxing gloves on and let's have a party. And that's pretty much how it went down. And then it imploded. So I had to consolidate and help him consolidate, the businesses at that time. But then I became an asset manager for kind of on the negative side of real estate with a lot of the major banks at that time,
Mm-hmm.
helping manage a lot of their foreclosures around the country.
Mm-hmm.
And I did that for about 2 years. All the meanwhile, knowing that, gosh, this is probably the time to start buying property. I just didn't have any money. I was getting killed. I was in real estate. I was getting killed in the real estate industry. But then I went to a conference, a Tom Ferry conference. I don't even know if you know who Tom Ferry is. He's like a real estate coach for
Mm-hmm.
realtors.
I heard about him. Mm-hmm.
And I'm sitting there in an audience with 5,000 people, other realtors, and he comes out on stage and rah-rahs everybody up and says, who here wants to buy rental income property?
Mm-hmm.
And all the realtors' hands go up and they're all screaming, they're all excited. Yeah, like, we want to buy rental income property. And then he's like, stops everybody and says, okay, great. Who
Mm-hmm.
here right now can financially go buy one today? And of course, 99% of the hands go down because everybody's getting hosed in the market. And he says, well, here's the secret you all are missing. He says, you don't have to have a single dime to own rental income property. He says, you just need to have friends that can buy your rental income property, because he says, you're the realtor. You're the person that has the license. You can find the deals. You can analyze them. You can put them together. You can manage them. You can run the companies. You can do all the sweat equity. You are extremely valuable to someone who has some money. So he says, you just need to go find that person that has some money that you can
There's
team
so
up with.
many.
You're bringing the yin to their yang. And that's how you start it. And like the light bulb went off for me, right? I'm in the
Oh,
midst
so
of
that
all
was
this,
a moment for you. Mm-hmm.
and I'm sitting there getting hosed. I think I had at that time like 25 grand in my bank account. Um, and I remember going to Chris, who ended up becoming my business partner. And I said, Chris, here's the deal. I can't sign on a loan right now, and I don't have enough capital to come in with a down payment. But I said, I can find all the deals for us. I can put them together. I can run it. I can manage it. I can do all the sweat equity. I can roll in commissions. I can do all this other stuff that's very, very, very valuable. I said, I just need somebody that I can partner with to bring in the initial down payment, sign on
Mm-hmm.
our first loan. Let's go ahead and split things 50-50 and let's rock and roll and build our portfolio. And it started literally with a $100,000 condo in the midst of the financial crisis in 2010. And we took it from there to where we're at today with 1,200 units and 200 million bucks. And we should have more, and we're going to more, but we're on our way. But that's it. There's a lot of obviously nuance in that, but that was it. That's what started it.
Yeah, I'm pretty sure there is. So I'm going to ask you this question. For our listeners who may be facing fear of financial uncertainty, what are the very first steps you took to rebuild both your mindset and your money after the loss? Because even though that was dad's loss, but you were working with him, right?
Yep.
So, and it's something whenever you have a setback or a loss, it changes, something in your mind, that frequency changes, right? So some people, they completely shut down, they just go into a box. Some
Yep.
people, they open up. So what was like that for you, share with us, and
Yeah. Yeah.
give
I
some
would say
advice to the people who are
the biggest
listening.
thing is the self work on yourself, because you
Mhm.
got to be around. I don't care if you're around the right people, around people in general, listening to podcasts, dealing with self development, going to conferences that where you're around the right mindset of people. But that kept me in a positivity mind. Okay. Number one, because it's very easy to get in negative self talk, negative rut, negative
Exactly.
this, negative
Mhm.
that. And so you got to move through that. There's ways you can do that. Tony Robbins is great at it, but there's ways you can do that. So that was number one. Number two was I watched what my dad went through and I understood why it happened. He was in the build and sell game. He was just very good at making a bunch of money, but he was also susceptible to losing a lot of money because of that, because he would mimic real estate cycles. And that's because he was in the build and sell game, not the build and hold game. And so I said, when I go do this, I'm going to do it based off of a buy and hold, right? I want cash flow and I want low leverage. Those were the two things. I said cash is king, and I want low leverage to where I can ride through market cycles, good, bad, or indifferent, on fixed rate debt and get through it. And so that's how we started, which is why, we literally went to a $100,000 condo, $25,000 down, fixed rate 30-year mortgage. So I was very conservative, right? 25% down, right? And it was cash
Mhm.
flowing beautifully. But then it
Mhm.
went to duplexes and fourplexes. And I wish we would have skipped that phase, because if I would have known now if I would have known then what I know now, I would have never gone to duplexes and fourplexes.
Mhm.
I would have skipped straight to a 10-unit property,
Mhm.
because I just understand how the money game works now, where I
That's true.
didn't before.
Mhm.
And that was huge, because once I understood that, okay, I can go buy a relatively risk adverse asset, call it an apartment building.
Uh-huh.
It's full of tenants.
Mhm.
And because there's 10 tenants in there in a 10-unit building, if one moves out, I'm still 90% occupied, right? If two move
Exactly.
out, I'm still 80% occupied. If one
Exactly.
tenant moves out of a single family home, I go from 100% to zero overnight,
Exactly. Mm-hmm.
right? Not to mention all the other expenses you carry too on top of that with a single family. So that was
Mm-hmm.
never an avenue. Single family rentals and all that other was never going to happen, because I wanted to diversify, right? I'm coming in from risk adverse, watching my dad go through a $60 million bankruptcy in the financial crisis, watching everything collapse around me. And so of course I'm like conservative Nancy over here, trying to figure out how can I grow wealth, but also do it to where I'm safe. Like a lot of people, right? They're in fear of market conditions. Well, when you get into multifamily, you're putting 25, 30% down on all these properties. Okay. And the
That's true.
reason you can put that much down is because you're doing it with your money and other people's money, because you're not the only one in there with the capital, but you get to run the show and you get to make great returns on your investment. And so that's where the game of OPM comes in. We can deep
Exactly.
into that, but that's the game of OPM, and using some of your money with other people's money who all want to invest in real estate. They just don't have the time or the energy to go do all the legwork and hustle and bustle. That's what you're there for. And because you're there doing all the legwork, your returns are stupid.
Very great, man. Yeah, exactly. So you shared a lot. So let's break it down a little bit more. Okay.
Yeah.
So we're gonna dig a little bit deeper over here. A lot of people do buy and sell. That's a one model, right? There's nothing wrong in that. So what did you see wrong in that model, buy and sell? You felt like, oh no, no, I wanted to do. buy and hold.
Yep.
I mean, my dad lost 60 million. There gotta be something is not working for him. That
Yep.
you saw that average people, like person who never did, like myself, buy and sell, I won't see it. So tell us that first.
Yeah, so I'm all for the buy and sell. So we still fix and flip, right?
Mm-hmm.
I'm for fix and flips. You just
Mm-hmm.
want to combine that with a long-term strategy,
Long hold.
both
Mm-hmm.
for tax advantages, right? Because if you're in the fix and flip game, you know darn well. And for all my fix and flippers out there and people that are doing this, it's very transactional hamster wheel. The margins are squeezing, the
Too
deals are
much
getting
stress.
tougher, all the
Mhm.
stuff's going down. And then when you make a profit because you're turning it in 12 months or less, you're in short-term capital gains. So you're
Exactly.
getting hosed, like hosed. And then you have to go do it all over again. And you're
Mm-hmm.
dealing with contractors who don't show up. You're dealing with increasing costs, margins that are squeezing. I mean, you know it. If you're in that game listening to this or watching it, you know it. And so we get a lot of people that are in that space that want to go and expand and say, listen, I want more passive money.
Mm-hmm.
Nothing's fully passive, but I want more passive money to where I'm
Mm-hmm.
not literally having to chase the next deal.
Mm-hmm.
And I know that I have X amount coming in from an apartment building or whatever it may be, mobile home park. I mean, you name it, right? Just income
Mm-hmm.
producing assets. And so that's where we could blend the two together, flip some houses, take the money, move it into a longer term hold where it's generating cash flow, it's generating profits, it's generating tax advantages, all the other stuff that a long term asset gives you. And then you hit the holy grail. This is why I haven't paid taxes in 9 years.
So what does that long term look like for you? Like 5 to 7 years, 3 to 5 years, 10 to 15 years? What exactly?
Yeah, listen, we want to get to 10,000 units and $1 billion in assets or greater.
Mm-hmm.
That's where I want to go.
Okay, but on your projects, how long is the hold for your each project?
Oh, typically 3 to 5 years.
3 to 5 years. Okay, that's what we do too. And then you also mentioned you learned from your dad. You wanted to go in cash flowing asset plus low leverage. So let's talk about that too a little bit more. So why low leverage is better? Because that you have to bring more money on the table, more cash on the table in order to do that. And in order to bring more cash, you have to raise more capital.
Mhm.
And when you're thinking about raising more capital, meaning you need to connect with more people, for the OPM, for the other people's money and the people who have the money, right? So it
Yep.
means increasing your network. So it's just like,
Yep.
the way I look at real estate is just like connecting the dots. And I think you understand maybe more than me. You're way ahead in the game than me, you know. And that's the reason you were saying it's a money game and you understood the money game. And I think it's more than the money game. It's multiple moving parts in this
Yep.
industry. So once we understand that, when we're able to connect the dots, it's just like a kind of smooth sailing. What do you think about that?
I agree. And yes, and you've probably heard this quote before, but the more hands you shake, the more money you make.
Exactly. So
Right?
take us through that journey.
Yeah, the more
How
hands you
did you
shake, the more
go?
money you make.
Because the
Yeah,
thing is,
so
there is a setback right there, $60 million loss, right?
yep.
That's the burden that you have with you, with your name, because even though your dad lost, you were working with him. So like,
Mhm.
okay, how did you gain the trust of people to invest with you again?
Yep.
Oh God, oh my God, they lost $60 million in 2008. In a right mindset, would I invest with this person again?
Yep.
Just strategically.
Yeah, yeah, it's a great question. It's turning it on its head in making people aware that yes, this happened. This is why it happened. This is the lessons learned from that, and this is how we're doing it differently.
Hmm.
Because yeah, if there was no lessons learned and I was just being arrogant, oh yeah, let's go repeat and rinse the same thing over and over again. We all know that's the definition of insanity.
Hmm.
So that's not what took place. And so it's acknowledging it, I think, is the first thing. Yeah, it wasn't me. It wasn't my decisions. It wasn't all of that. But yeah, sure, I was a part of it. But at the end of the day, you know, what people care about most, at least from what I found in raising capital,
Hmm.
is does the deal make financial sense? Number one. Okay,
Hmm.
check mark. It makes great sense. It's going to give me 15, 16, 18% a year on my money.
Exactly.
Cool. Okay. Do I trust you? Right? If I give you 50 grand of my money, are you going to treat it well and fight for it and
Hmm.
ensure to the best of your ability that we're not going to be on an American greed show in 2 years?
Hmm.
Right? because that's what people care about most. And what they care about also is that you are protective of the money. So when you can actually come to the investors and say, listen, we can go leverage this thing up at 80% plus in leverage. We're choosing to be at 65 to 70 to protect your money, all of our money better. They love that. They understand that the returns may not be as astronomical, but it's also being risk friendly. It's not risk adverse. You're just being conscious of, hey, you want to protect both in good times and bad times, right? I want to be sitting on a property where I can take a 25% vacancy and still pay the bills, which, by the way, is happening on one of our properties right now, right? Because of just market dynamics and things we're fighting against. And so because of that, I don't have control over the markets. But because we have 62% debt on it, at fixed rate at 5.4% for 10 years, we're able to ride through and fight through this thing. Whereas if we were leveraged up, party's over. Keys are going back to the bank and you look like a jackass.
And a lot of operators are going through that right now. And I'm not sure if it's exactly the same scenario that we saw in 2008 that we're seeing right now.
Actually worse.
Yeah, so I would like to hear your, view on that as well. So share with us, what do you see different now from your experience, 2008 crisis and now, because your experience is firsthand over there.
Yeah, so we'll see how your audience enjoys this one. So the residential side of the market's fine, relatively speaking, because we don't have subprime loans, we don't have negative AM, we're not at 100% finance with all the crazy financing tactics that were used in residential back in 2004, 5, 6, 7, 8. Okay, so that's cool. The problem is not in residential. The problem is in commercial, because what happened since pretty much 2018 all the way through 2022 is all of these bridge debt loans.
Exactly.
Where they're variable rate with the concept of going in, doing the value add approach, and then refinancing out of that 2 years into a fixed rate debt program. That works beautifully when interest rates are reasonable.
Right.
That party ends really quickly when interest rates go up, and when you go to refinance, it doesn't work, right? And the values drop, and then you can't even get money, and it becomes a cash in refinance, not a cash out, right? That whole game. And that's what's been going on to where people can't even refinance. And so they can't even get out of these bridge debt loans, right? So now you're stuck in this 7, 8, 9, 10% loan that you can't get out of, and you're like, you can't even pay the bills, and it turns into a complete S show, and things are going back to banks. So it's on a bigger scale because it's billions and like $700 billion. There's like $705 billion this year alone in 2025 that was coming due. And the banks are having to figure it out. Now, the good news is the problem's too big. So the banks are forced to deal with it, right? It's not like they can just start foreclosing easily because the problem's too big that if they just went, screw it, let's force everybody to refi, and if they can't, we'll foreclose and blah, blah. No, they can't, because they do that, the party's over. I mean, you'll see everything collapse like you've never seen before. It'll make 2008 look like a walk in the park. So they can't do that. So they're having to modify some. They're having to extend some down the road and just kick the pile down a little bit, right? They're having to work with certain things. So that's what you're seeing happen in the commercial space. But I don't even think that's our biggest problem.
So what is the biggest problem?
Currency. We're getting close to a currency crisis.
Oh, really? So
Yeah.
enlighten me on that as well, since you're talking about that.
So most people don't know this. So back during COVID, the Chinese created the digital yuan. The US also countered that, and they created the digital dollar.
Right.
They know the ship's too far out to sea, right? When you have $37 trillion in debt, and by the end of this podcast, it'll go up probably $400 million. I don't even know. Yeah. So it's filling up with water. They know this. Even President Trump knows this, why he's pushing so hard on the crypto space and why you're seeing that take off and do what it's doing now, because they realize they have to exchange in some way into a different currency. And the typical fiat dollar that we've been accustomed to for the last 50 years as the world's reserve currency, it's coming to an end. And I don't know how that shift is going to go down, but it isn't going to be pretty. And so the best piece of advice to give anybody is buy as many tangible assets as you can. Why do you think gold is 4,000 an ounce right now?
I know exactly. It used to be like 200 when I came to this
But yeah,
country.
I bought our gold stash at 1,100 an ounce. And
Yeah, I bought at
that was about
200
10, that
and
was almost
please.
6 years ago. Whatever it was. It was like literally 1,100 an ounce, whenever that was. And now it's
But
4,000.
last year I bought it at 1900 too during
Yeah.
this time frame. And then it's like more than double now. Every year is like going super crazy. So I think people are investing in precious metal. I agree with
Yeah, they're
you.
investing in tangible assets, and
Mhm.
you could even throw crypto into that a bit. It's not
Mhm.
tangible, but it has intrinsic value through the
Yeah,
blockchain.
it does.
Ethereum, Bitcoin, the main ones, XRP, and a few others. And then you even have in there what's called the USDC coin, right? The US stable coin.
Stable
And that
coin.
mimics the US dollar. So if
Right.
I was going to give any advice, no different than I've done for myself, I've pulled anything greater than 6 months of
Mm-hmm.
cash.
Mm-hmm.
Do not keep it in a US bank account.
Mm-hmm.
So think about your expenses. Anything over 6 months, you need to stick it, even if you stick it into the Coinbase and attach it to the USDC coin, right? So it's not being traded. It's literally like it's a digital coin though. So that way it's actually safe and it mimics the US dollar. So it doesn't really move or fluctuate at all. I mean, it's almost like creating a new bank account, but it's
Right.
outside of the US fiat. And then that way, if there's a whole show that goes down, you have access to your money and you can move it anywhere you want.
Yeah, I think the problem there is because it's such a new phenomena for people, the digital currency. And don't get me wrong, I'm not against it. I'm for it because that's the
Yeah.
future, because that's what we're stepping into. I call it limitless world. That's what we're stepping into with
Yeah.
all this blockchain, digital currency, or whatever is happening around us. So we are going beyond our limits. We are challenging our status quo. Basically, that's what is happening. But a lot of people are not embracing this because it's such a foreign phenomena. All of a sudden, it's like something tangible that you can touch, like, $10, $100 bill kind of thing. And then it's something up in the air that I don't even have the clue what it is. Or do I
Yeah.
have it or don't have it? And plus, we do not have enough I think laws or anything to protect ourselves. Now I think there's a lot of protection, they're doing it. But before, remember, people lost their money too. You put it in the
Yeah.
air,
Yeah.
it's gone, it's over, it's done basically. So people do
Yep.
not have that much confidence yet.
Yeah. Yeah.
Eventually it
Correct.
will
And
happen, but not. But since we are in real estate, we are buying real estate and we syndicate our projects. What do
yep.
you think? Is it a good idea for people to invest at this time in this market if the deal is right?
Of course. 100%. Yeah. It's all about the deal, but it's not chasing deals.
Mhm.
So in multifamily apartments, right, if you get a certain percentage return annually, that's considered a pretty good deal, right?
Mhm.
And based on the metrics. And you're buying, and it's the tax advantages, right? There's really four big benefits of an apartment building. Number
Mhm.
one is the cash flow. Number two is the appreciation, so the profits. Number
Mhm.
three is the tax advantages to wipe out your income taxes, your personal income taxes for the rest
Mhm.
of your life. And number four
Mhm.
is the inflation hedge. So when you're
Exactly.
going up through all the stuff, our apartments and rents and everything, we're going up with it. So you hedge against that and you have a long-term tangible asset that's sitting there. It's not going anywhere. I mean, you can go do the math and you can fact check this. No time in US history in a 10-year span have apartments not doubled in value.
That's true. And that's how, we see all this millionaire, billionaire, they have a huge stake in real estate, right? Because that's how they
I mean, when
multiply their wealth.
Blackstone, yeah,
Yeah.
when Blackstone goes out, and I think it was 1.3 trillion
Mm.
invested, if I'm not mistaken. I'll double check that number, so don't quote me on that one. But an
Mm-hmm.
enormous amount into real
Mm.
estate, right?
Mm.
Rentals primarily, right? Apartment portfolios, but also rentals and single families, et cetera. What they're seeing is what they understand to be we're turning into a renter nation,
Mm-hmm.
similar to what Europe has done. And we're just 10 years behind them, but now it's coming to where you're seeing because of the cost of housing and everything else
Mm-hmm.
going on, it's very
Mm-hmm.
difficult for the young and the youth in our country to go buy homes.
Mm-hmm.
So they're being gobbled up, right, by all these big corporations and stuff, and individuals and investors and other people, international too. And everybody else is renting. And some
Mm.
people choose to rent. Some people choose just because they think it's more feasible. And so,
I think newer generation too, they are more like experiential generation. That's why we have all these new companies popping in, like Uber
Yep.
or like Uber Eats or whatever. I heard about it's something new, like Airbnb is called Pad something, Pad
Oh,
Share.
Pagonia.
No, I think pad share too something is
Okay.
something like Airbnb, but it basically is a co-living kind of thing.
Oh,
So you can do that. I think it's getting popular in California too. So I think a lot of things are happening because of this shareware kind of mentality, because
yeah.
the newer generation is more like experiential. They don't want it to hurt like older generations like us, wanted to buy a big house, nice car, just kind of
Yeah.
show up kind of thing. So that era is, I think, pretty much over. It's more like, experiential. I want you to experience life. I know one of my friends, they're just nomad. They are real estate investors, and they've been like kind of on the run for the last whole year, traveling so many countries throughout. They sold their home and they're just investing in their experiences, I think, and that's most important to people these days.
Yeah. I mean, if that gives you fulfillment, and
Exactly.
by all means, man, because at the end of the day, that's what you're here
That's
for.
what really matters, right?
That's what you're here
So,
for.
I'm going to ask you this. So, what mistakes do you see investors making now, in this time that reminds you, that kind of similar things happened or went bad in 2008?
Yeah. I call it you working for the analyzer or the pro forma, right? If you're looking at a deal and the numbers on a deal, you end
Mm-hmm.
up adjusting those numbers to fit what you want
Mm-hmm.
versus the other way around, right? That deal should be working for you. The numbers are what they are. And it's just not over speculating, keeping it real, because I see way too often, especially in the broker world, God bless them, but they're there to sell deals. And they'll put all the fugazi on those pieces of paper. And if you're not, somewhat savvy in the market, you're going to use numbers that are just not accurate. And then you end up closing the deal and it doesn't work. Right. And then you're kind of now you're fighting yourself the whole way through. So, I mean, I've made that mistake in the past and thankfully been okay with it because we've worked through it, but don't make it anymore. The numbers are what they are. And that means you need to look at more deals
That's
because
true.
it's just the
Mm-hmm.
way it is, and not over leveraging yourself, and not over speculating on the analyzer, the deal pro forma that you're putting together.
Yeah, I agree on that because the thing is you have to live in the present. So most of the time we're underwriting looking in the future, right?
Yep.
What's gonna happen 5 years from now? This is gonna be my cap rate at exit. This is what it's gonna look like for me. And then we're bringing those number into present. And I
Yep.
think sellers, they do the same thing too, right? Because they're projecting, okay, if I sell this, how much money this person's gonna make 5 years down the road. So they
Yep.
bring those number into their pro forma.
They
And that's
try.
so that
They
seriously, that is
try.
like whole thing is like that. Everybody's trying to polish the
But
numbers.
here's the
Mhm.
beautiful equalizer on that.
Uh-huh.
A thing called the bank,
Mm-hmm.
because the bank doesn't let you anymore prophesize on
Mm-hmm.
the future. It just
Mm-hmm.
doesn't. They're not giving you a loan based on the future hope and pray anymore. That was about 3-4 years ago.
Mm-hmm.
Not anymore. Now it's based on what are the financials today. We're going to give you the loan based upon today. The
Mm-hmm.
only way we'll even give you any thought of future rents is if you
Mm-hmm.
have to do no renovations on that property, and you could literally bump that rent after it matures in its lease cycle in the next 12 months.
Mm-hmm.
Then they may give you a little bit of that future look. Otherwise, today's rents, today's deals, today's expenses, as it is today in the present, is how you're getting your loan. And you need to underwrite your deal specific to that, not the hope and pray. The hope and pray is the hope and pray. And if it works
That's so
out,
true.
awesome. But the
Mm-hmm.
bank isn't giving you that anymore. They were doing that a few years ago, and that's why we're in the trouble we're in. That ship has sailed. So that's the good equalizer. Is I will tell the brokers all the time, listen, John, Mr. Broker, I totally appreciate you doing this. And yeah, we may make that in the future. We
Mm-hmm.
may. But I can't get a loan on that. And I can't get investor money on that. And I can't make this thing happen on that. I have to underwrite based on today's financials. So if your seller wants that money, they want that price, then they better get these rents today so I can give them that price. Otherwise, they're getting this today. That because it's based on financials. That's it. It's not like a love thing. We're not in a love fest. Either the numbers work or they don't.
They don't work. Yeah. And especially if you're going on the agency, Fannie Mae or Freddie Mac.
Oh yeah,
So it's a
hyper
total
conservative.
litmus test for you for your deal at that time. And then think investors should be cognizant of that as well. So
Yeah.
I wanted to ask you this question now. How are you personally positioning your portfolio differently today? Because you have that experience and now this market experience. So, our experiences make us who we are. So tell us what differently you're doing in today's market.
Yeah, so we're just underwriting deals based on the present. That's the main thing.
Okay, that's a
That's
good one.
that's numero uno.
Mhm.
And sure, can we find home runs and can we hit the future numbers? But we will put more money down because investors are risk scared. I call it risk adverse right now. And
Mhm.
so if you can present to them protection of money
Uh-huh.
in addition to tax advantages,
Uh-huh.
that speaks more than, oh, here you can potentially make 18% or 20% a year. Whereas if I can tailor that thing down and put more money down, and therefore the returns go from 18 to 15, you're still cool with that because now we're protecting your money more with
Mhm.
less leverage. We're buying down the debt because that's the only, if you really think about it, the only way you ever lose in real estate at any point is if you're ever forced to sell a property when you don't really want to.
Mhm.
Think about that.
Mhm.
The only time you will ever lose in real estate is if you have to sell a
Sell
property
the property
when
or
you
give it
don't
back to the
really want
bank.
to, because now you're
Yeah.
susceptible to timing that you don't like,
Mhm.
whereas timing you control.
Mhm.
Because if you have enough leverage or lower leverage on it and you're cash flowing that thing and it's not a problem, then you will hold for the time that's right for you and your family or for you and your investors. If you're forced to sell it because you can't pay the bills or because you've over leveraged it and you can't pay the debt, now you're forced to sell something when you don't want to, regardless of the market. It could be a crappy market and you're forced to sell it. Well,
Mhm.
that's when you
That's a
lose.
sad position to be in. Yeah, I agree.
Yeah.
And finally, what gives you optimism today? Are there opportunities hidden in this volatility like there were in 2008 as well? Because people made money in that era too.
Yeah. No, and they're making money now. I mean, having access to capital to go take advantage of some deals right now is really key. Um, you know, people keep saying our rate's going to go down. They are going down. The key to the whole thing is that 10-year treasury.
Mm-hmm.
So right now it's hovering about 4.1, 4.2. If we can get that 10-year treasury under 4, right around 3.8 to 3.9, that's going
Mm-hmm.
to put your interest rates on all of the mortgages and the commercial properties and everything somewhere in the fives to low fives.
Right.
That's going to allow things to start really moving transactionally again,
Mm-hmm.
and make deals really start to pencil. So I'm optimistic about that because I do
Me
believe it's going
too.
to happen. I do believe whether we hit a hard recession or kind of a light one, we kind of need it, right? We kind of need it.
And we're already there already, it's
Well,
already happening.
it's
There's some people think it's a rock bottom, but
yeah.
there might be a little bit more. I think it's just like picking back up a little bit now. I do see some little bit uptrend as well
Yeah.
at this time.
It depends on your market, right? I mean, it
Mm,
depends on what asset class you're in
mm,
and your market location in the United States, because some coastal markets that are tight supply wise are doing okay. And then you get into areas even like Las Vegas, where I'm at right now, where the housing market sucks and there's a lot of
mm,
supply and the prices are going down and things are changing both
mm,
residentially and commercially.
mm.
I would say that we are turning the corner on the commercial space, in my opinion. So we are starting to flatten out, bottom out, because we've been going through a real rough ride the last 24 months, even call it 36 months, but really since early 2023, been pretty rough. So let's call that 2 years worth of time has been pretty rough. I believe we're bottoming out. We're starting to turn the corner. Deals are starting to get refinanced. Deals
That's
are
true.
starting to move forward. Banks are working with people. Things are transacting. Yes, some people are losing. Some people are winning, but we're moving through it. We're moving.
Yeah, yeah. I think it's changing the market a little bit, but we'll see what's up in the horizon. But we are out of time and we gotta go to a rapid fire round. I'm gonna ask you 5 questions. You're gonna answer it in one word or one sentence only. Okay?
All
Ready?
right. Woo!
Whatever
Pressure.
comes to your mind first. One book that shifted your money mindset.
Atomic Habits.
Oh, I love that book. I have that one too. The biggest myth about real estate investing.
That it takes a lot of money to get started.
Oh, that's a good one. Faith or numbers, which drives your decision first?
Say that again.
Faith or numbers, which drives your decision first?
Oh, numbers.
Favorite daily wealth habit?
My wealth habit is I use Monarch Money. So that helps me automatically categorize all of my spending every month.
Just like Mint, right?
Yeah, well, so Monarch bought Mint.
Yeah.
So Mint's no longer, so that is Monarch now. But
Mhm.
I use it to auto categorize all of my money so I can track things pretty nicely without a lot of effort each month. And some people are scared to look at that stuff. I get it, right? But you need to look at that stuff
That's
because,
true.
you need to automatically be putting some money away into some retirements. I know this is longer than a sentence, but yeah, Monarch Money.
I like that.
Yeah.
In one word, what does wealth vibe mean to you?
Frequency, like it means money frequency because, yeah, it's money frequency. That's
Thank
what that means.
you. I love that answer. Thank you so much, Justin. Your journey is such a inspiring. I think it was like a master class in resilience, basically for me. You
Thank
have
you.
shown, like, true resilience, coming from a huge loss and building your empire to 180 million, right? That's pretty
Yeah,
awesome.
it's up over 200 now, but yeah, it's the
It's
same.
over 200. Okay, so I have the old data. Wow, that's pretty awesome. So how can people reach out to you?
Go check us out on YouTube. I'm kind of directing everybody there to enjoy some long form content, free, and learn about multifamily, learn about investing. Go to so it's Justin Brennan Multifamily, Justin Brennan Multifamily. Watch away and enjoy it, and then if you want to come in further, you can.
Thank you so much, Justin. I really enjoyed our conversation today. And to everyone who's listening, remember that greatest wealth comes not from what you have, but from who you become, when you go through all these different challenges in your life. So stay inspired, stay intentional, and keep building your wealth vibe. Bye for now.
Bye bye.
Bye, Justin.
Thanks for tuning in to the Wealth Vibe Show. If you enjoyed the episode, be sure to subscribe and leave us a 5-star review. And don't forget your free gift. Download the Busy Professional's Guide to Real Estate Investing at loombainvest.com. See you next time with another amazing guest and another powerful conversation.